So hello and welcome to this joint session between Ecovis and Investment Quorum. We have a budget next week, the most exciting time of the year for tax professionals. There's a massive black hole in the public finances and we all know we're going to have to pay for it somehow. I'm Ruth Potter, Head of Tax at Ecovis, and I've been invited to host today's event. Over the next 30 minutes, we're going to explore what we can expect from next week's budget, an excellent opportunity to get egg on all of our faces, what you should be doing before the end of this tax year, and finally what opportunities there are now and what might the future hold. Then we're going to finish up with a short Q&A. So if you have any questions throughout the session, please enter them into the Q&A box on your screen and we'll hopefully get through as many as we can later on. Our panelists this morning are Petronella West and James MacDonald. Both have over 30 years experience and should be well placed to discuss the topics today and answer your questions. Petronella is the founding CEO of Investment Quorum, a boutique wealth management firm that delivers high-end financial planning and investment solutions to clients, trusts and charities. And as I'm sure you'll see today, she is incredibly passionate and knowledgeable about what she does. And James looks after the personal tax team at Ecovis and provides excellent and relevant tax advice to our private clients and business owners. Our firms have a long history of working together, a very long history of working together for our mutual clients. I can speak for my firm when I say it is a very important and valued relationship. So I'm going to set the scene today and paint a picture of doom and gloom on this very early morning. So I hope you've got a strong coffee to hand. The numbers don't make it hard for me to do. The economic impact of the pandemic has been devastating, and the Chancellor is faced with the difficult task of putting in place strategies for recovery. The emergency spending on the pandemic has accounted for 3/4 of the record rise in borrowing, and the OBR has estimated that the government deficit will hit an eye-watering £394 billion this tax year, the highest recorded level since World War II. The OBR's forecasts also show at least a £30 billion annual hole in the government's finances by the middle of this decade. In addition, because of the economic impact of lockdown, tax revenues are forecasted to be £100 billion lower than expected. It's £100 billion this year than expected. So tax rises and public spending cuts look inevitable unless there is a strong and quick economic rebound post-crisis. As you can see from this beautiful pie chart, I think, thanks Kathy, the majority of our tax revenues come from income tax, national insurance contributions and VAT. The top 50% of income earners in the UK pay 90% of the total income tax revenues. CGT plays a relatively small part in the overall tax take. It raised just over £10 billion in the last tax year. I'm sure many of you are aware of the Office of Tax Simplification's reform proposals to the government, where they recommended the government look at addressing the distortion between capital gains tax rates and income tax rates. Aligning these two could only be realistically expected to raise between an additional £5 and £14 billion in tax. In addition, a 1p increase to income tax rates could raise up to only £7 billion per annum. So what is Rishi to do? Taxes overall in the UK are already at a 70-year high. So James, hello. Is there a consensus on what areas of personal taxes are most likely to be targeted in next week's budget?
Yes, thank you, Ruth. Good morning, everyone. As Ruth said, capital gains tax is something that has been in the government scrutiny for a while. The rates of capital gains tax are considerably lower at the moment than those for income tax rates, with a maximum 28% as against a maximum income tax rate of 45%. So the likelihood is that although it's a fairly small tax, it's a fairly easy one to change. We're not likely to see any structural changes, we don't think, in the way capital gains tax is calculated and administered, but the likelihood is that if there is a change, it will be in the rates chargeable. may see more emphasis on taxing investment properties, particularly residential investment properties, and possibly some restrictions to principal private residence relief. For example, the grace period of deemed ownership may be reduced still further from its existing 9 months. Dividend tax rates, another possibility at the moment, again, generally speaking, lower than income tax rates. The first £2,000 a year of dividends currently can be received free of tax. We may see that go. May again see an alignment with dividend tax rates from their top rate of 38.1% up to equivalent rates to income tax. Again, all things are possible. National insurance contributions for self-employed people. Well, the Chancellor said that when additional help for the self-employed was announced for the coronavirus pandemic, then it would have to be paid for somehow. So we may well, in fact, see an alignment of self-employed national insurance contributions with those paid by employed earners, which could see possibly another 3% or so on employed national insurance contributions. Pensions relief been very much in the firing line lately, but again, there is still some scope to restrict it, possibly the top rate of tax relief being across the board reduced to 20%. Further restrictions on the amounts that can be invested, and also long been, as I'm sure Petronella will agree, it's long been in the discussion forum that the 25% tax-free amount that can be taken out of a fund could be at risk. But I mean that has been held as sort of sacrosanct for many years. So if we see a change, that it'd be quite out of the blue, perhaps. Income tax and VAT. Ruth mentioned a possible 1% increase across the board in income tax. It is possible. Anything's possible in the current situation, but there have been, it has to be remembered, manifesto promises by the government not to increase the rates of income tax and VAT. So, I wouldn't rule it out, but equally, I think it will be very a long way down their list to do.
Thanks, James. And I would add, speaking as a corporate tax specialist, that I think it's probably quite likely to see, maybe not this coming tax year, but in this Parliament, a temporary increase to corporation tax rates, certainly for larger businesses that may have benefited from the crisis. So thanks, James. So Petronella, one for you. What sort of kind of advice would you give to our audience about what needs to be considered?
Yeah, good morning, everybody. Well, it is indeed quite a scary black hole of debt and issues that we've got to deal with. I think the most important thing when you're coming at it from the financial planning perspective, and what we really try to work with our clients is to, with the threats that are coming and the changes that are coming, is really all about having a plan. And we particularly think it's really important that you maximise every year those allowances. There's still sort of about 4 weeks left before the end of the tax year, although it does fall around Easter. So those of you who are thinking about waiting till the 5th of April, think again. Aim for the 31st of March. But I think the main things are to really consider using your ISA allowances, your pension allowances. Yes, it's quite complicated now with the tapering and the rules. But if there's money that can be got in, definitely, there's a real call to action there to get that money in. And also, there's obviously a lot of discussion around capital gains tax. There's lots of opportunities now with utilising your allowances. Should you be increasing over and above the CGT threshold of 12,300 and pay 20% tax today, or potentially 40% tax later on in the year? I think it's really important not to just be driven by the tax. Although we are, there are threats. I mean, I've been in financial services for over 30 years, dare I say it. And I think it's important that you don't just look at it from the tax perspective. Obviously, if capital gains tax would go from 20 to 40, that's a significant amount in your gain. But you can also dilute that gain over the years by just making sure you use the reliefs regularly. So it really, for us, it's coming back to having a plan, clients, looking at your finances and having an end goal in mind, and then trying to be as fiscally prudent as you can be, but taking really good account of making sure that it's right for you, not just because the tax rates are going up. And it's the use of these allowances, as James will notice, it's use of allowances every single year that gives the maximum boost to your personal circumstances. So it's that thing of just being organised, having a plan, and perhaps looking at it. But do make sure that you do look at everything between now and the end of the tax year. So it is still a short window. We've got no holidays allowed during March in Investment Quorum to make sure that we're all on hand to help our clients.
Yeah, I need to have a word with you actually, Petronella, on that point. James, in terms of tax, are there specific tax saving measures that can be done for individuals or business owners?
Yes, thanks, Ruth. Yeah, I mean, I can only echo what Petronella has just said, really, as a starting point. Make use of the allowances that are available to you. If you've got capital gains at the moment, it's a low rate comparatively. So, you can make use of your annual exemption by no longer bed and breakfast shares, but you can sell shares, and your spouse, if you have a spouse or civil partner, can buy them back. Equally, you can buy shares back into your ISA and take advantage of putting them into a tax-free wrapper and making use, as I say, of the annual exemption. The other big area, of course, is strategic use of pension contributions. Anyone with income in the bracket of £100,000 to £125,000 a year faces a potential 60% top tax rate because of the abatement of the personal allowance over £100,000. And making pension contributions, provided you're within limits and everything to do that, would be a very sensible way to bring that level of gross income down below the level at which you're starting to lose your personal allowance, and thus avoid that 60% tax drop. Dividends, again, while the rates are lower than income tax rates, if you have a personal company, you should look to whether there's a possibility of paying a dividend before the end of the tax year. An interim dividend, much easier to arrange than a final dividend in terms of the documentation that needs to be recorded for it. Have a look at the structure of your company's shareholdings. If you've got a spouse who could possibly take shares in the company, or adult children, you could look at allotting shares to them so that they can also benefit from dividends. And again, really for people who have either a personal company or have some control or influence over how their remuneration is directed from the company, salary sacrifice or whatever, personal pension contributions by a company are extremely tax efficient. I mean, pensions investments not absolutely for everybody, and I should say, with a nod to Petronella, you should take regulated financial advice on any pension planning you're contemplating. But a pension contribution by a personal company can stand in the place of a salary deduction. You wouldn't pay any personal tax or national insurance contributions on that pension contribution, and the company can claim a corporation tax deduction in exactly the same way as if they were paying you a salary. So if it's possible, very, very tax efficient, but not automatically for everyone. Again, just to come back to that 60% potential tax rate, gift aid, if you're considering making a donation to charity or have a particular need to reduce income below the £100,000 drop zone, then a gift aid contribution would also effectively do that. But just to echo Petronella, it's a case of looking at your circumstances in the round and taking advantage year of year on the allowances that are available to you.
Yeah, understood, James. So I've got a question for you, Petronella. Do you think there will be a green living aspect to this budget?
Well, it's an interesting question because, everyone's, perhaps apart from Donald Trump, everyone's aware that there's a problem with climate change and the impact it's having everywhere. And the United Nations Principles for Responsible Investing activities that took place over the last few years is having a real impact on how investment houses, and also how we as want to invest our money. And I think that, it would be, whilst a lot of the subsidies have gone on lots of the renewable energies, sort of solar power and things like that, we are still seeing a huge amount of opportunity there. And potentially Rishi will perhaps, in order to not have everything being the takeaway in terms of the taxes, maybe give something back in terms of more sustainable or focuses towards sustainable investment. I mean, we think it's such an important area that we're actually launching a new sustainable investment strategy towards the end of March, simply because of the call to, I mean, not only for us as a business that we feel it's really important that we look at the, the carbon footprint or the social impact that, companies are having for us as a business, but also for our clients. And I think there's a huge appetite. Hopefully, with the effect of the pandemic, one of the positives could be that we are all having a greater social conscience for the world we live in, and perhaps how our purpose changes as a result of the impact of everything that's happened. So, yeah, I think there's a possibility. But I mean, equally, I think it's very clear today how much people want to try to make a difference if they can. Unfortunately, sometimes profitability comes first. So I think, in all these sectors, it has to have a commercial benefit in order for it to have a significant impact. But yeah, in that particular area, we're quite excited about the opportunities that the markets represent themselves. And I think, these days it's not just about what have I got in my pension, it's actually, can I do something good with my pension, or can I make some kind of positive change? So, that means that clients and alike can actually perhaps have a more of an impact on what's happening out there. So yeah, I do. Hopefully we might see something on that area.
Good. Okay, thank you. So James, I've got a question that actually already had a question for the audience, but this is my next question to you.
About
the future, and could we see a wealth tax?
Well, I mean, it has been considered in the past under the coalition government, and there are other countries close at hand in Europe that do have a wealth tax. It's always been regarded as not part of the UK tax landscape. We already have various taxes on property and so forth, but overall wealth, yes, against the background of of economic emergency, for want of a better expression, then perhaps the government might consider it, and generally speaking, it may be a little bit more palatable overall for people to accept that there should be a levy on holding wealth, but overall, I mean, there's things that they could consider. So they could set a fairly low bar, for example, on asset worth, but perhaps exclude the principal private residence, for example, so that doesn't come into the mix. So that, generally speaking, people who own a normal asset base won't be, could be presented as only taxing the very wealthy. But equally, the bar could be set at something around the region of £500,000. It's as open as that. But with that in mind too, I mean, in terms of wealth planning, wealth preservation, one should also, I think, look at opportunities for inheritance tax planning at this stage and take advantage of the available release for that. I mean, there is currently there's a gifts relief which hasn't changed since many years, but you can give away £3,000 a year of capital to anybody at all and exempt it from for inheritance tax purposes. Each individual can do that. So, and also, if you've not made a gift in the preceding year, you can take advantage of the allowance from that year as well. So, potentially, a couple could give away £12,000 a year with no inheritance tax consequences to children or whatever. Another area of inheritance tax planning that's not really considered regularly is of course the ability to make gifts out of normal income. If you have a high income, you can give away any amount potentially, so long as it doesn't diminish your normal standard of living. In other words, that it would have otherwise have gone into saving or investments had you not divested yourself of that wealth. And that is an area to look at, to pass money down out of your estate, avoid a potential wealth tax. There's a number of areas. Again, I suppose too, looking forward, with public sector cuts and so forth, the population, we may become more dependent on the intervention of charities and so forth to pick up where the government can't afford it, and for inheritance tax purposes, bequests to charity are tax-free. Again, something to consider. But And I suppose finally the other thing, we're looking at a situation where I think the government is going to claw back money from wherever it can. So we may well see, the old system of fiscal drag, as it used to be known, coming into play, that allowances and exemptions are not going to increase. So to go back to what's sort of developed into a theme, I think take advantage of the allowances while they're there.
Great, thank you, James. So Petronella, what else should we be considering from the financial planning side? Are there any other aspects we should be considering?
Yeah. Well, I mean, when we were debating kind of like topics for today and been obviously just following all the news and the stories and the things that can impact by the budget, I think as we've been saying all the way through this, I said you can't really, if you make use of all the allowances all of the time, regularly, even if the gifting allowances are quite small, if you use them over several years, you can actually get quite a lot of money out of your estate, and it's sometimes sort of the rate of inheritance tax at 40%. Obviously, there's also a whole committee devoted to trying to see if they can simplify the whole inheritance tax rules. But I think the thing is, on 100,000, you can gift away 100,000 relatively easily over a few years. That's 40,000 inheritance tax that's saved. So sometimes it may seem like the allowances are small, but it's about if you look at things regularly, and you keep up to date regularly, and you see your financial advisor, your tax advisors on a regular basis, making sure that you're looking at stuff from a forward planning basis. I mean, I always love the 31st of January, because clients are putting things together, kind of on the 28th of January to submit. But of course, there's no opportunity to plan then. It's just too late. Whereas if you start dealing with your affairs early in the tax year, you've got an opportunity to plan ahead. And I said, I think we do have a window here. I think as not sure how much fiddling is going to be done on pensions. There's been so much already, and it's impacted very negatively into some of the big superannuation pension schemes. So I'm more agnostic on that, but it's always a hot topic. But as I said, if you've got the opportunity to get the money in, then get the money in. And so so I said in this window of opportunity, it's really important. And in addition to what James was saying about planning for inheritance tax, also things like, have you updated your nominations on your pension? I mean, we had a case the other day where the pension benefits were paid to a former spouse because the individual had forgotten to update his death benefit to his current spouse. And it's not a foregone conclusion. So it's not just your tax needs to be planned, it's your, the infrastructure of your personal finances needs to be planned, because otherwise you're not looking at everything. I mean, the accident with Tiger Woods just the other day just goes to show how, you never know when something might happen to you really extraordinary and really awful. And being prepared and being planning for all of that is an equal really big part of it. So even though we are facing this black hole that we know we're going to have to pay back, we've got a very wise chief investment officer, Investment Quorum, who's got 50 years experience. And always when I get a bit kind of antsy about what's going on in the markets, he's always wanted to say, we've seen, of course we haven't seen the pandemic before, but there's, endlessly there's icebergs, the bit you can see and the bit that you can't. We actually think more importantly than just looking at the taxes is look at what's actually happening with your money. So we work incredibly hard for our cash that we deploy into pensions and ISAs and tax planning and investment of our businesses. But actually, where is that money being deployed? We talk about ISAs a lot. But what's the point of a cash ISA? Because an ISA wrapper is there to protect you against tax. But if you're not getting any income and you've got any interest, then what's the point? So use your ISA effectively by investing. And at the moment, asset classes like cash and fixed income and property are not likely to offer very good returns for the future. So, this is, I think, one of the questions that I've seen popped into the box about, why we're launching a sustainable strategy and launching that this year is simply because there's been a lot of you've got to make sure that you're not, you're buying into really good quality investments. But for us, it's about make sure your portfolio is in good quality companies. Think about the thematic changes of the future. The impact of working from home for sure is going to have a very, very big impact on the property sector. I mean, Lloyd's and HSBC coming out the other day talking about how they're going to be pulling back on their property portfolios. So it's what your money's in, because if you're sitting in a property fund for the next 10 years, you might find you're not going to get much in the way of returns. I'm not suggesting everyone piles into Bitcoin and GameStop, but we are seeing obviously a lot of bubbles in asset prices at the moment, in terms of what people do with their money. But, do sit down with your financial advisor, your investment advisors, and make sure your money is actually being deployed. So having made good tax decisions, are you actually making good decisions with your money? So, you know, as I said, James and I work regularly with clients to make sure that we're looking at things from both aspects. And sometimes you want to be looking at through all the lenses at the same time to see the impact of different things. So, you know, now is the time to act. Now is the time to do something, but from a wide variety of different things.
Is there any positive news out there?
Well, we had that discussion. I mean, I think the fact is that there is a lot of positive return in markets for sure. Yeah. There's a lot of risk. There's a lot of volatility. There's a lot of uncertainty. That's why we, you know, the frame of this theme today is about, can there be any certainty? I think the vaccines are a real positive. Yes, you know, I mean, right, yeah. You know, sometimes it's easy to look at things from a negative perspective, but I mean, you know, everyone's going to complain about every politician there is. But fundamentally, we've got some incredible vaccines. There is a solution. We always like to say that, I mean, the technology that must have driven to that vaccine is just incredible. And I think the rate of development in those sectors is really exciting. So it's easy, again, as one of our mantras is, you know, where there's a negative, there's always a positive. But yeah. The fact is the vaccine is here and working.
Yeah, and also, you know, to take on from that, you know, technology, I think, you know, R&D in the future is incredibly important. Also, now they're out of Europe, certainly for corporates. We're looking at sort of creative tax release, R&D release, and I think government would be foolish to touch those, but well, they want to encourage investment in our, you know, our future. So
absolutely,
there's such important industries for us. So great. Okay, thank you. So we've had a couple of questions. One asking about wealth tax, which I think we've covered. I don't know if you want anything to say anything further about that. I don't think we need, I think we've covered, I mean, yes, there could be a wealth tax. What would it look like? We don't know. Possibly $500,000 bar, possibly, you know, 2% charge over a, you know, a 5-year period. Incredibly hard to administer.
The Swiss government had quite a long, hard time, didn't they? Trying to administer a wealth tax. Not an easy thing to do.
No. Yeah. I'm thinking of gifting to my kids. Should I do it before the budget?
I think there's. Joan, do you want to come in here?
Well, yeah, yes. I mean, if you're in a position to do that, I mean, you know, the one thing that I suppose that the one cautionary note is if you're looking at gifting assets rather than cash, then there is a potential risk because you and your children are, for want of a better, or in fact, to use the true expression, connected for capital gains tax purposes. If it's an asset that has a substantial capital gain on it, you could actually crystallize a capital gain on transferring it to your children. So something to be very aware of. And in fact, you might want to take advantage of the lower capital gains tax rates by doing it at this stage rather than waiting to, waiting to see what happens in the budget. But yeah, certainly there is a there is a potential to do it. I wouldn't say it was an automatic thing to do, but it was something that you were considering doing. Then probably now rather than later is a better option.
Yeah, I think that also, I mean, the junior ISA limits went up significantly last year to 9,000. The downside is that it seems that HMRC thinks kids should get their money at 18 and they're very sensible, but they're actually financially literate till 25. So there's always a note of caution when putting money away for children into junior ISAs because it's very tax efficient. The risk is, of course, your children then get full access to that money at the age of 18. I think one of the things that I think is really important in today's world is that families start educating their children to be custodians over wealth as opposed to sort of beneficiaries. And I think, again, I'm a big supporter of educating kids in schools to make sure that they're more aware of the importance that the money's not just there for the fast car in the university or for the travelling, but also to start to build down roots over time. And you can get valuable benefits putting money into kids' pensions. You can 2,880 into kids' pensions, and you get 20% uplift on that. So again, it's about the allowances may be quite modest, but if you use them consistently over a long period of time, you can accumulate a good amount of money that can be outside your estate. So it's a good question.
We've had the dreaded B word mentioned, I'm afraid. What effect do you think Brexit will have on the UK economy in both the short and long term?
That's difficult. I mean, with all these, my view on, or our view on this is that It depends on the longevity of your time, what your time horizon is, because yes, there's going to be a lot of upsets. We're seeing it already in financial services about where we can and can't give advice. We can apparently give investment advice to a client in Spain, but we can't talk to him about his pensions if he's living in the Costa del Sol. So there's going to be lots of things that still need to be ironed out. So in the short term, I think it's about being aware that there could be, there can be issues for businesses alike. And when you look at the domestic market here in the UK, you want to be looking at very specific thematic sectors as opposed to just buying in the UK markets. I think markets will be a little bit under pressure, although the pound's very strong at the minute, which is unexpected. But I think it's about, if you've got a longer term view, I think the Brexit thing will eventually wash itself through. So we remain pretty agnostic about it, to be honest with you, and it hasn't had a major impact on our portfolios.
I mean, speaking for a lot of my clients who, large multinationals, cross-border transactions, Brexit has been a bit of a nightmare, certainly for the last couple of months. Certainly with, obviously goods crossing borders, there's been quite a lot of difficulty trying to just get customs declarations done by somebody, because we haven't got enough customs agents in this country, but hopefully that will iron itself out in the longer term. We've got a question actually I think this was from the chat box. This was probably for you, Petronella. How do you go about picking the best investment funds for your clients?
Well, I mean, we've got a fairly robust strategy at Investment Quorum. So, we adopt this philosophy of sort of blue sky thinking. And Peter Lohman, our Chief Investment Officer, who's got a significant amount of experience through all different seasons, we're looking ahead. I mean, we're looking beyond the pandemic now. We're looking over the next 10 years, 15 years. So it's a combination of looking ahead for the right themes and sectors that you need to be invested into. And then we buy predominantly funds for diversification. And it's about, we've got mantras when we pick investments for our clients. Number one, they need to be, our staff and our directors, board of directors all invest the same way as our clients. So our interests are all aligned. With the use of technology, there's a lot of opportunities for screening out kind of, the sort of so-called dog investments. So we spend a lot of time making sure that the underlying investments are high quality by screening through technology. And then now we've got a team of 4 analysts working on, around the clock to make sure that we find everything that's in there.
Oh, we've had a lot of questions come through now. Shall I keep going, or
yep.
Got a bit of time? Yeah, excellent. Okay, so how nervous should owner-managed businesses, OMBs, be about next week's budget?
I don't think nervous. I think, given what we're saying, I mean, yes, there's always risks about increases to, as I said earlier, dividend tax rates and so on. And if you are in the habit of taking your remuneration by way of dividends rather than as a salary, then yes, I mean, you should be considering ways you could mitigate tax on that. I mean, again, as a wider question, yeah, there could be a whole lot of things that owner-managed businesses need to be aware of. It depends how many employees you have. We may see changes to what can and can't be done through payroll, for example, and it's a very, very wide area. But I wouldn't say nervous would be the way I would face it. I think planning and being aware of the changes to listen out for announcements in the budgets that may affect employers, but there could also be positive incentives to employers as well. I think the furlough scheme has kept many businesses ticking over. Now, whether there's grounds for that to continue indefinitely, well, we can't afford for it to continue indefinitely. But it's and planning for possibly the end of a furlough scheme. Then yes, I think that's much more a consideration than any tweaks that that may occur in the budget.
Okay, thanks, James. We've got a question here. What happens if you make a large gift to children, for example, over £3,000? Does it trigger tax for the giver or the receiver?
In short term, no. Because it can be a what's considered to be a potentially exempt transfer. or it could indeed be a gift out of income if you have income of a sufficient level that you would otherwise just be putting that into savings or investments. Then there wouldn't be no inheritance tax consequences either for you or your children. But the potentially exempt transfer is the one that people have probably heard of most, which is the one that sets the 7-year clock ticking. So if you make a large gift at this point and you survive for 7 years from the 7 calendar years from the date of the gift, then it will not be classed as part of your chargeable estate for inheritance tax purposes. So no, you can make a gift in excess of the reliefs. Just be aware, keep a track of it. It's potentially exempt from inheritance tax, but not automatically.
Yeah, and I think I'd add in there that if you're going to make a gift, get on with it. You'd be amazed the amount of people go, oh, I'll do that next year or the year after, and then of course that 7 years is quite a long time. So if you do want to make gifts to family members, get on with it. And the other big one, as James said, is you must keep good records, because actually doing taxation post-death, because it's a difficult time, and there are complex tax forms to fill in. And if you've got to start rooting around for data, it just puts a lot of pressure on, the kind of those that are left and suffering as it is without the loss of the individual, and then having to deal with really complicated affairs. So good record keeping is a good part of financial planning as well.
Absolutely, I agree.
A couple of questions around the capital gains tax and whether or not would it take effect, immediate effect, or will changes be phased, and if so, how long?
I think on the capital gains tax, I think it's difficult when it's this late in the year to slam the gate. I mean, they have done it before.
They have
there is I think under a previous government, but I'd be surprised personally if it stops. So fingers crossed there's a win. I mean, also if they're trying to raise money, what a good opportunity to incentivize people to liquidate their portfolios now and raise some tax before it happens.
Absolutely, I couldn't agree more. That they may well, it would be a complete little bonus for them if people started assets at this point. So yeah, I mean, as Petronella said, it's perfectly possible for government to implement regulations from the date of the budget, and now for a very long time. It's been, the last comes to mind was under the Blair government.
Great, good. Well, I think we are possibly running out of time now. So do you want to do one more question, or Petra or James, or
take one more question?
One more question.
There's one here that I just seen from Nigel with so rather than an unpalatable tax rises to repay the pandemic debt, would a long-term strategy be a better approach? And yeah, and that is certainly something that is economically a very good idea. Effectively package the debt up, look at it as a long-term repayment thing. I've heard it referred to as box it in Pandora's box, and put it to one side and ignore it. But no, see it as a long-term debt. Yes, I mean I think that in financial sectors, I don't know if you've come across that, Petronella, but it is certainly something that is being mooted as one.
It's definitely been, these kind of, it's sort of a war bond type thing, isn't it? Sort of a COVID recovery bond, and we'll be forced to purchase that. These are things that we've never seen or haven't seen for a long time. So nothing would surprise me. I think one of the questions also there from Raoul was about, whether other countries in the same predicament. And I think this is a global problem. I mean, some parts of the world, we get a bit more excited about Asia now because they seem to have been so efficient at dealing with the pandemic so quickly, that actually their countries are recovering much quicker. And I think it's an important note that, a big percentage of the population live in Asia, and they've got a lot of control over most of the major commodities. And we're sitting today in a potentially some sort of start of a commodity super cycle. So I do think that perhaps Western governments were much harder hit post the global financial crisis, and then again with the pandemic. The US, printing money is obviously has a benefit because it's put a lot of money into the systems. But as I said, that is going to have a drag at some point in the future. We were kind of waiting for it from the global financial crisis, and then we're probably going to see some suffering for that over the next 10 years. And I think that comes back to, we look at this taxation, we've got a window of opportunity to use some allowances, but it's about having a 10 to 15 year view. Short term, it's like a cash ISA for 1 year, but actually if you can protect your returns for the long term. So, and I think governments, our generation, younger generations, are going to have to deal with this for quite some period of time to come. And I think there are going to have to be more dramatic measures taken centrally by government, and it's always something that we, and again, one of our mantras is don't fight the Fed, because I think I think that the idea is that you keep your financial planning, your tax planning, and your investment management all focused on longer term goals, and don't worry too much about tomorrow, but kind of the immediacy of tomorrow, but having a more strategy around that.
Great. Positive then, really. Yeah. Start off with doom and gloom, but thank you both so much, and thanks to everyone for joining us today. Plenty to think about, and obviously if you have any further questions, please do not hesitate to contact us. Yeah,
and I think we're recording today, so we will be the recording will be available to download, and so on behalf of Investment Quorum, I want to thank everyone also who's attended today. That was great.
Good. Thanks Petronella. Thanks everyone. Great.
Thank you all.